Hi guys, so we come to another market outlook, and the topic is the market has gone very high, at least for the S&P 500. And what should I do next year? And we can see from here, this is taken out of JP Morgan's slides. Whatever president is in charge, the stock market continues to rally. Even if there's even if there's a recession, the markets may come down, but eventually goes up because the S&P 500 is driven by the top 500 businesses in Singapore, the top 500 businesses in the US which have global reach. So when you buy the S&P 500 businesses, you're actually partaking in the global business. For example, Nike shoes. Nike, right? It sells shoes all over the world. Asia probably takes up quite a large portion of the market share. So it is a global market that you're buying, a global business. And it's not just about US. Next, a little bit about my fund that I run. This is in German. There's a translation if your Google Chrome allows you to translate into English. In fact, this is English. So I'm just sharing this not for marketing purposes. This fund can only be sold to accredited investors who reach out to me to assess your suitability. We have reached 134.72 for the NAV. It's been about slightly over 2 years. So on average, the return has been about 18%. Now, this is in Sing dollar terms. If it's in US dollar terms, it is close to 140, 145 because the Sing dollar has appreciated against the US dollar. So last year, 2023, we have been up about 24%. This year, we are up about 21 to 22%, slightly underperforming the MSCI World for this year. Last year, we outperformed it. Now, the key thing is that there were some tweaks to the strategy. As you can see over here, it plateaued for a while before there was a spurt. I shall show you this part here. As you can see, the bulk of the returns was from the last 3 months. It is up 11.19%. So year to date is about 19.3 in Sing. Sharpe ratio 0.75, Sortino 1.1. Now, what led to this sudden jump from 3Q? There was a tweak in my strategy, which is not due to leverage. We did not increase the risk. If you see what I did, 92% is still in shares, 6.8%, some of it is into funds and a little bit into options. Majority of the investments are in US dollars, and 83% is in US shares. One of the things that I did to tweak the performance was that at the start of this year, it was very diversified, and the highest holdings I have for a stock was about 4%, and I have close to about 45 stocks. I became more convicted the second half of the year, and the top 10 stocks now account for close to 48% of the portfolio. That increases the volatility, but I use options to overlay. So there were some put options and call option strategies which make the risk-adjusted return more favorable. In the businesses more convicted that I buy, they are all high-quality businesses with toll road effects. That means subscription model, very predictable business with wide moats. A lot of them get recurring earnings all the time, and that's what I look for. Sticky businesses that continue where the clients are stuck in the ecosystem, where the firm continues to provide value and they move them from one business to another business, and then the wallet share increases, and this is what I like. So I do have some preference, some biasness to what it is about. Next, I'll talk about the outlook of the stock market. What lies ahead for the stock markets? I expect the S&P 500, which is 6051, to rise to about 7,000 points before having a correction and then ending the year at 6,006. The reason being there are two put options. One is Trump. There's the most stock market conscious president in the US who clearly wants the stock market to do well. I think he's a capital markets person. Stock market does well means easier for fundraising, right? And the CEOs are enriched by the higher share price. They are paid a lot by shares. And the second put options is the Federal Reserve, because inflation is coming down there. They will probably cut 2 more times, and that will ease off a lot on the real estate sector companies that are borrowing. And so it will continue to push the stock market up. I know the broad market is expensive, but then there will be a correction. It could be about 10 to 15% correction. Not expecting a bear market, then a recovery. So what am I going to do? Okay, so bear in mind there's nothing to fear for this. Just to share with you the chart. If you look at the long term of S&P 500, it is on a weekly chart. These corrections are just a tip of the iceberg. So what if it ends, it goes up to 7,000, it drops and then recovers back? These are opportunities to buy. Now, if you stretch the S&P on a longer scale, these are all blips. They are actually buying opportunities. And then if you look at Nasdaq, it's about averages 14% per year. The S&P averages about 10% per year. Now, even within the broad sector, there are beautiful companies that are trading well below their fair value. For example, Medpace, yeah, it's been trading below their 200-day moving average. I think fair value close to 450, and you can see that the revenue has been growing consistently. Yeah, and I wouldn't worry about it. These are signs of a quality company. Basically, if you look at the annual results, revenue has been growing from 420 million, 22 million to 1.89 billion. I don't see a problem with that. Then, you know, and if you see the net income is also been consistently growing. So earnings per share, diluted earnings per share, also growing. So that means shares outstanding has actually been declining because they are buying back shares. So these are things I look out for. There are so many companies that are trading well below their fair value. Thermo Fisher, for another example, look at this, been hit by the scandal, but revenue has been tremendous. Same thing, going up, net profit going up. We have United Health. Recently, the CEO of the subsidiary has been shot dead because of alleged not payment of claims. But look at the revenue. Insurance is so sticky a business, right? Once you embark on the policy, you hardly get out of it, and it shows in the revenue, and it also shows in the earnings per share. Almost every year going up, and the number of basic share count, diluted shares outstanding has been kind of stable, right? So they are all very very recurring business. United Health is probably worth close to $500. You have Mercado Libre 1809, also came down recently. Interesting companies like Brookfield. I know it looks very topish, but the fair value is $88. Brookfield is into everything. It's like conglomerate like Berkshire. It's into fund management. It's into infrastructure. It's into a lot of the private equity, private credit, which you bought some of the, you could have come across some of the products as well. So conglomerate, sticky business, fund management, asset management business. Once you're in, the clients have to pay the management fee, performance fee. So this is a very good business as well. So there are a lot of opportunities. So what I do is that even if the market is very topish, I will pick stocks that have been down quite a bit, and then below their fair value. So research has shown that once a stock has already dropped 20%, it's good quality companies. When the general market drops, they will not drop so much. In fact, they may buck the trend. So that's how I intend to buck the trend. Yeah, so there's nothing to worry about. In summary, what I will do, even though the general market is very high, P ratios are high, but we all know that P ratio is not a proper representation of valuation because it depends on how much growth is coming forward. So I will be picking up stocks that are already down 10 to 20% below the intrinsic value of very high quality businesses with recurring businesses, recurring revenues, and wide moat. So research has shown that if I buy stocks that are down, even though the general market is up, they will not drop anymore when we come over to this drop, this ultimate correction. So the second thing is, as we rally along, I've been reducing leverage and increasing cash holdings for my clients. And if the market rallies further, let's say we hit 7,000, one of the best defensive posture is to hold 10 to 20% cash. 10% is very normal. So when the time comes, as the market goes down, number three, I will be buying put options, buy put spreads. So I'll be buying puts at about 5% below the spot, maybe 6 months put. But I'll be selling two puts about 20% away. The reason why I sell two puts 20% away is I don't think the correction will be more than 20%. And even if it does, and I get hit by two puts, at 20% discount, S&P would have been at close to 5,004. It will be a value again, right? So I'll be doing put spreads to defray the cost of buying one put. That's one example. There's another defensive strategy. And when the time comes where we reach a turning point and you can see that the markets are cheap again or fair value again, I'll be looking for bargains. So that's number four. So there will always be things to do. And when you're a stock picker, you're no longer picking funds. You're looking at unearthing companies that are temporarily disliked by investors. So that gives me a lot of opportunities. I could be going to China, looking at Hong Kong companies. Alibaba is still way below the intrinsic value, probably worth $200. Tencent. So there will still be stocks to pick. Even in Europe, a lot of stocks are bombed out, and they are definitely good for the picking. And so because I have a global mandate, I can hold bonds, I can buy government treasuries. There's a lot of defensive posture, and then we will ride along. So in the long term, we will still be doing well because the S&P will still be going up beyond that, right? So any kind of correction is actually an opportunity to buy. We just had one bear market in 2020, very short-lived one, down 36%, and then the Fed came and rescued them with money printing, and then another one which is pretty long, starting from end of 2021 all the way to October 2022. It's almost 1 year, 10 months of correction, about 25% at one stage for the S&P. So we had two bear markets within the space of 4 years. It doesn't happen that way. Most of the time it's one bear market every 3 to 4 years. Right? In fact, the statistics show 5 years because S&P is up 72% of the time, or 75. So 3 out of 4 years is up. The fourth year may be down, statistically up. So hang in there. Things are looking good. The two puts are in place. So I'll be staying focused.